Welcome back to the show, everyone. Today, we're diving into a hot topic that confuses a lot of retail traders: CFDs, futures, and spot trading. On the surface, they may look like different ways of trading the same assets. But when you peel back the layers, the mechanics, risks, and even regulation, or lack of it, tell a very different story. With me is Cycle GF, an expert who's been studying these markets deeply. Welcome, Cycle GF.
Thanks, Alex. Glad to be here. This is one of the most misunderstood areas in trading. And honestly, it's also one of the areas where a lot of traders get scammed without even realizing it.
Let's start from the basics. People hear about CFD trading, futures trading, and spot trading. How are they actually different?
Good question. Let's break it down. Spot trading is the simplest. You're buying or selling the actual asset at the current market price. For example, if you buy Bitcoin on a crypto exchange in spot, you actually own Bitcoin. Same with stocks. You own the shares. Futures are contracts. You don't own the asset itself, but a legal agreement to buy or sell at a future date. Now, futures markets are centralized and regulated with clear rules. CFDs, or contracts for difference, are a whole different beast. Here, you don't own the asset. You don't even own a contract that trades in an exchange. You are basically making a side bet with your broker on whether the price will go up or down.
So with CFDs, the broker is the casino? It sounds like red or black, banker or player, up or down. That's about it.
Exactly. And this is where it gets dangerous. With spot and futures, there is an order book. You see the bids, asks, liquidity, and market depth. Market makers are visible. With CFDs, the order book is hidden because there isn't one. You're trading against your broker, and your wins are their losses.
That sounds like a rigged game. No wonder it's not a regulated market, because there isn't any.
It usually is. It's often rigged. Okay, brokers can manipulate spreads, freeze platforms, or even run stop hunts. Those liquidity grabs, where traders' positions suddenly get wiped out. In a regulated markets, a stop hunt is just a natural market mechanics. Buyers and sellers pushing against each other. In CFDs, your broker can literally create those wicks on the chart to flush you out.
Now, many people think when they trade CFDs, they're trading the Wall Street market or trading Tesla shares, when in reality, they're not. How does that marketing trick work?
That's one of the biggest scams. CFD brokers use the branding of real markets. They will say trade gold, or trade Euro USD, or trade Tesla, trade Apple, trade the Dow Jones, US 30. But you're not touching Wall Street. You are only betting inside their system. They are piggybacking on the name and movement of the real asset to sell you a fantasy of trading like a pro.
So what about leverage and risks?
Great point. In spot markets, leverage is limited. You buy with what you have. In futures, leverage exists but is regulated. Exchanges set margin requirements, and in CFDs, leverage is sky high and often advertised as the attraction, like 100 times, 200 times, 500 times. It can reach up to 1,000 times, by the way. But that's designed to wipe you out quickly. Most retail CFD accounts lose money, and that's by design.
What about the regulations? Who is the regulator, and what does FOREX trading license mean?
Spot markets in stocks and regulated crypto exchanges are overseen by financial authorities like SEC, FCA, or similar. Futures are heavily regulated. CFDs, on the other hand, are barely regulated in many or all the jurisdictions. I mean, they just provide them with an operating license for the CFD. I mean, there is no regulation per se for the CFDs. In fact, in the US, they are outright banned. They're not allowed to operate in the US, and the foreign CFD operators, they're not allowed to accommodate US citizens, by the way. It's illegal. But brokers set up offshore entities, advertise globally, and lure traders with flashy ads and fake promises.
So in reality, with CFDs, you're not trading the market. You're trading against your broker who controls the rules.
Exactly. And that's the part many don't understand. They think it's just like trading stocks or crypto, and it's a real market. And then sometimes they even compare with the size of the overall currency market, that there are trillions of dollars being traded. And it's all false, okay? It's not. There is no transparent order book for CFDs, no regulated exchanges, no neutral market makers. Everything is controlled by the CFD provider.
Wow. And when people see those social media ads, trade the S&P, trade oil, trade gold with zero commission, that's just bait.
Right. The bait is the illusion of Wall Street. But the reality is closer to a casino, a slot machine. You are betting against a house, pretty much. And the house has every tool to make sure your money ends up in their pocket.
Earlier, you said CFDs are a shadow game. Let's drill into that. When someone opens a position on a CFD platform, say they go long on gold, what actually happens behind the scenes?
Now, here's the dirty truth, Alex. In real markets, spot or futures, your order goes into an order book. Buyers and sellers match. But in CFDs, there is no real order book. Even though some brokers, they say A book or B book, all this crap, it doesn't exist. There is no A book or B book. It's just, it's a made-up story to look like as if there is an order book. There is no real order book for CFDs. Your order doesn't go to Wall Street or any market or any exchanges, or not even or to a crypto exchange, and so forth. It just goes into the banker's black box. The moment you hit buy, the system has visibility of your entry price, your stop loss, if you placed one, and even your leverage size. Think about that. The broker knows exactly where your pain points are.
So the broker already knows your map of survival?
Exactly. Yep. And this is where manipulation starts. Let's say you buy at 100. Very often you will see the price tick against you almost instantly, even if the broader market is flat. The little opposite move isn't random. It's the broker's dealing desk or algorithm probing for your liquidity.
Liquidity? You mean your stop loss?
Yeah. In trading terms, liquidity is where the stops are. Clusters of pending orders. On CFD platforms, they simulate this by running the price action towards those obvious stop zones. Bots take over, stretch the moves, and hunt your stops. It's like they are fishing, and your stop loss is the bait.
So it's not just the market moving naturally? The platform is actively tilting the board against you?
Right. Here's how the cycle usually plays out. 1. Entry fade. You open a position, the price immediately goes against you by a few pips. This shakes confidence. 2. Stop loss hunt. The algorithm drives price toward the cluster of retail stops, because remember, they see where most traders place them. 3. Spread hike or spread spike. just as stops are about to get triggered, the broker widens the spread artificially. Suddenly, your stop gets hit, even though the real market never touched that level. 4. Fake wick and reversals. Once stops are cleared, the price often snaps back in the original direction. So retail traders are stopped out, and the house has pocketed the losses.
That sounds eerily similar to how slot machines are programmed. Near wins, fake excitement, but always tilting back to the house.
Yep, and it doesn't stop there. Other manipulation tricks include, like platform freezes. When volatility hits, your CFD platform lags or disconnects. By the time you're back online, your position is liquidated. Meanwhile, in the real spot or futures market, liquidity is still there. Other things like asymmetric slippages. When you lose, your stop executes instantly, often worse than expected. But when you win, suddenly your order has slippage and your profit is reduced. And also you'll find things like synthetic charts. The price feed, they show you can deviate from the real underlying market just enough to trigger retail stops. They can insert fake wicks that never happened on regulated exchanges.
You've shown us how CFD brokers hunt stops by pushing price against traders. But I've heard traders say, hey, when I compare my CFD chart to TradingView or to another platform, the candles look different. What's going on there?
That's a very sharp observation, Alex. Now, here's a trick. Most CFD brokers align their open and close prices with the real market feed. That way, if you quickly glance at the chart, it looks identical to Wall Street or the futures market. But where they manipulate is the highs and lows, the wicks. Okay? Let's say the real futures market printed a candle from the gold price, let's say 2,950 to 2,960, closing at 2,955. The CFD broker may show the exact same open and close prices, but stretch the low wick down to 2,940 for just a fraction of a second. That phantom wick never existed in the real market, but on their platform it exists just long enough to hit thousands of retail stop losses.
So the scam is subtle. From a distance, the chart looks legit, but if you compare the highs and lows carefully across platforms, you'll see differences.
Oh yeah, and most traders don't do that comparison. They will compare the close. Yes, gold closed at 2,955, and here, and on Bloomberg, same thing. But if you look at the intraday wick, their platform dipped to 2,940, for instance, while the real market only touched 2,950. That $10 difference is where thousands of accounts get liquidated. So think of it as the broker inserting fake spikes, needles on the chart, that justify why your stop loss got hit. But in reality, that wick was engineered. On a regulated spot or futures exchange, the wick represents real executed trades in the order book. In CFDs, the wick can be manufactured out of a thin air.
And most retail traders blame themselves. They say, I placed my stop too tight, or I just had bad luck. When really, it's the game that's rigged through wick manipulation. This all sounds pretty grim. If CFDs are tilted against the trader, is there any way to fight back, or is the game just unwinnable?
It's tough, Alex, but there's a crack in the armor. Market makers, even on CFD platforms, they are the weakest during high-impact news events like Fed rate decisions or CPI releases, non-farm payrolls, or sudden geopolitical shocks. Because during those moments, volatility explodes. The brokers, bots, can't perfectly control the price because the real underlying market is moving violently. Liquidity is thin, spreads blow out, and the algorithms can't disguise fake wicks as easily. Now here's the tactic. Wait for high impact news. Don't trade randomly. Sit patiently until a big scheduled event or sudden news shock. 2. Confirm an extreme move. Watch the chart. If the price shoots away above or below the normal range, let's say blast 3 to 5 times the usual ATR, which is the average true range, in one candle, you know that's unsustainable. 3. Counter trade the exhaustion. Instead of chasing the move, you do the opposite. If gold just spikes, let's say, $70 or $80 in 1 minute, you short it. If it just dumped $50, you go long. 4, take quick profits. Don't get greedy. The idea is not to catch a new trend. The idea is to fade the market maker's overextension, grab a few points on the snapback, and then get out. Number 5, repeat only on similar events, meaning this isn't a daily grind strategy. It's opportunistic. You return only when the same type of volatility event happens again.
So you're saying the mistake traders make is thinking they've caught the right direction after news, and then they follow the trend. But that's what market makers want, right?
That's right. Chasing the trend is what gets you slaughtered. Market makers want you to think, oh, the dollar spiked, so it must keep going. But after that giant move, the bots switch roles. They reverse it, liquidating everyone who chased. The smart play is to fade the exhaustion, scalp the snapback, and then leave the table. Think of it like waiting for the casino dealer to slip a card. You don't play every hand. You wait for that one misstep where you have the edge. That's how you survive in a game designed to beat you.
That's a powerful strategy, waiting for market makers to overextend and then fading the exhaustion. But I have to ask, doesn't this still carry risk?
Absolutely. And I want to be crystal clear here. This isn't a guaranteed win system. News trading is dangerous. Volatility cuts both ways. Spreads can blow out, platforms can freeze, and slippage can eat into your edge. The tactic works because you are exploiting the market maker's weakest moment. But you still need discipline. Keep position sizes small, use tight risk controls, and take profits quickly. Never assume that you've caught the new trend. This is a quick in and out play. Okay, this is not about hanging on to a trend kind of thing. It's in and out. So the more you trade less and you wait longer, strike only when the odds tilt, and never forget you are still in a casino. The goal isn't to beat the house forever. The goal is to know when to take your chips and walk away.
So the lesson is, CFDs are stacked against retail traders most of the time. But if you're disciplined, patient, and wait for those rare high volatility events, you might actually turn the tables for once. Brilliant way to end. Cycle GF, thank you for breaking down the dark side of CFDs and showing us not only how they work, but also where traders can protect themselves and maybe even fight back.